Sales of securities at financial institutions. So a lot of banks have another part of their business that is the broker-dealer part of their business, and some banks are advisors as well. So if there's sale of securities occurring at a financial institution, there are certain rules that must be followed. Wherever practical, broker-dealer services shall be conducted in a physical location distinct from the area in which the financial institution's retail deposits are taken. So it's a separate office. The broker-dealer's name shall be clearly displayed in the area in which the broker-dealer conducts its services, so the name's on the desk. At or prior to the time that the customer's securities brokerage account is opened by a broker-dealer on the premises of a financial institution where retail deposits are taken, the broker-dealer shall disclose, orally and in writing, that the securities products purchased or sold in a transaction with the broker-dealer are not insured by the FDIC, they are not deposits or other obligations of the financial institution and are not guaranteed by the financial institution, and are subject to investment risks, including possible loss of the principal invested. So that must be disclosed orally and in writing, because we don't want to confuse when people do securities transactions on the premises of a bank. We don't want them to think that these things are covered by the FDIC, because they're not. So disclosed orally and in writing at or prior to the time in which the brokerage account is opened. The broker-dealer must make reasonable efforts to obtain from each customer a written acknowledgement of the above disclosures during the account opening process. If they forget to do so, they haven't violated the rule, because the rule says they must make reasonable efforts to obtain a written acknowledgement of the disclosures. So that's kind of a funny rule. The Uniform Prudent Investor Act. This is a law that I would expect will help you answer anywhere from 2 to 6 questions on your test. It used to be that we had what was called prudent man rules, but those went away, and we replaced them with what we called the Uniform Prudent Investor Act. The changes came about primarily because of the modern portfolio theory that was developed by Harry Markowitz. The theory that said that some things that might seem risky by themselves, when they're looked at as far as in the context of the portfolio as a whole, they're not as risky anymore. So back in 1952 was when he first came up with this idea, but the Uniform Prudent Investor Act came along many, many decades later. So you're going to have questions that are going to ask you to make decisions on how to manage the assets in a trust, because an IA or an IAR may be named as trustee. And I mean, short of doing the best thing for your client, you need some rules, and these are those rules. So this is a really important law. It will help guide you in quite a few questions on your test. So the Act, the Uniform Prudent Investor Act, regulates the investment responsibilities of trustees. It's comprised of 16 sections, but I'm only going to cover the sections that are most important for your exam. A trustee, under the Prudent Investor Rule, a trustee who invests and manages trust assets owes a duty to the beneficiaries of the trust to comply with the Uniform Prudent Investor Act. That's Section 1. Section 2, Standards of Care, Portfolio Strategy, Risk and Return Objectives. A trustee shall invest and manage trust assets as a prudent investor would, by considering the purposes, terms, distribution requirements, and other circumstances of the trust. In satisfying this standard, the trustee shall exercise reasonable care, skill, and caution. A trustee's investment and management decisions respecting individual assets must be evaluated not in isolation, but in the context of the trust portfolio as a whole, and as part of an overall investment strategy, having risk and return objectives reasonably suited to the trust. So are you evaluated on each investment decision you make? No. You used to be, but you're not anymore. It's in the context of the whole. Among circumstances that a trustee shall consider in investing and managing trust assets, the general economic conditions, possible effects of inflation or deflation, the expected tax consequences, the role that each investment or course of action plays within the overall trust portfolio, the expected total return from income and the appreciation of capital, other resources of the beneficiary, needs for liquidity, regularity of income, and preservation or appreciation of capital, an asset's special relationship or special value, if any, to the purposes of the trust or to one or more of the beneficiaries. A trustee shall make a reasonable effort to verify facts relevant to the investment and management of trust assets. A trustee may invest in any kind of property or any type of investment consistent with the standards of this act. There are no categorical restrictions. There used to be, but there's not anymore. A trustee who has special skills or expertise or is named trustee in reliance upon the trustee's representation that the trustee has special skills or expertise has a duty to those special skills or expertise. Section 3 of the Uniform Prudent Investor Act discusses diversification. A trustee shall diversify the investments of a trust, unless the trustee reasonably determines that because of special circumstances, the purposes of the trust are better served without diversifying. So generally, diversification is better than not, but maybe there's a situation where you don't want to or need to, but it serves the purposes of the trust. Section 4, duties at inception of trusteeship. So you're named trustee. When should you look at the assets in the trust? Within a reasonable time after accepting a trusteeship or receiving trust assets, a trustee shall review the trust assets and make and implement decisions concerning the retention and disposition of assets in order to bring the trust portfolio into compliance with the purposes, terms, distribution requirements, and other circumstances of the trust and with the requirements of the Uniform Prudent Investor Act. Section 5 is a term called loyalty. A trustee shall invest and manage trust assets solely to benefit the beneficiaries. That's for whom the trust was established. Loyalty requires the trustee to respect the interests of all of the beneficiaries. Section 6 deals with the concept of impartiality. Many times the trust is going to have more than one beneficiary and they're going to have competing interests. So how are you going to manage those trust assets? If a trust has two or more beneficiaries, the trustee shall act impartially in investing and managing the trust assets, taking into account any differing interests of the beneficiaries. So no one person wins. So if there's two people and one person needs the money now and one person doesn't need the money ever, you manage it 50-50. No one beneficiary takes precedent over the other. You have to remain impartial. It says that prudence in investing and administration requires the trustee to take account of the interest of all the beneficiaries for whom the trustee is acting, especially the conflicts between the interest of beneficiaries interested in income and those interested in principal. Section 7 deals with investment costs. In investing and managing trust assets, a trustee may only incur costs that are appropriate and reasonable in relation to the assets, the purposes of the trust, and the skill of the trustee. So reasonable expenses. Section 8 is reviewing compliance. Compliance with the prudent investor rule is determined in light of the facts and circumstances existing at the time of a trustee's decision or action, and not by hindsight. Lovely. Aren't you glad that you're not judged in hindsight? Could you imagine? So that's a good rule. Section 9, delegation of investment and management functions. A trustee may delegate investment and management functions that a prudent trustee of comparable skill could properly delegate under similar circumstances. The trustee shall exercise reasonable care, skill, and caution in selecting the agent, establishing the scope and terms of the delegation consistent with the purposes and terms of the trust, and periodically reviewing the agent's actions in order to monitor the agent's performance and compliance with the terms of the delegation. As long as you do this, you're allowed to hire a money manager when you're the trustee of a trust. But you have to pick a good money manager and monitor them, review their performance, and get rid of them if they're doing a horrible job. So long as you're monitoring them, you're not going to be held responsible for any decisions that the money manager that you have delegated this function to should make. So the Uniform Prudent Investor Act, it will help you answer quite a few law questions. Conflicts of interest and other fiduciary issues. Excessive trading, churning. Should you ever engage in churning? Never. If your client doesn't mind the fact that you're trading every day for them, does that mean that it's a good idea that you're trading every day for them? No, of course not. So churning is not allowed. It's actually prohibited. Even though the client might have not expressly told you to not do it, doesn't make it a good idea. We know that you would never want to engage in unauthorized trading. You could never place an order for customers without their specific oral approval, unless they have contractual agreement giving them, so the IA has discretionary authority. Advisors cannot place trades based upon somebody else, like the lawyer for the business wants to make a trade in the account, not unless the lawyer has third-party trading authority. We know advisors cannot borrow money or lend money to a customer unless the customer is a broker-dealer, a financial institution, or an affiliate. Broker-dealers shall not overstate or omit material facts regarding their qualifications. Advisors may not represent to clients that they are investment counsel unless their principal business consists of acting as an investment advisor, and a substantial part of their business consists of rendering investment supervisory services. We said that if the IA uses research of others, that is allowed, so long as the source is disclosed. Advisory fees must be reasonable. They must not be out of line with fees charged by other advisors for comparable services. Conflicts of interest are allowed if disclosed to your client in writing before any advice is given. You can make no performance guarantees. Advertisements must be fair. Testimonials in the investment advisory industry are prohibited. You cannot disclose your client's information unless you have permission of the client or required by law to do so. If an IA has custody, there are some special rules. Client funds and securities must be segregated, properly marked and deposited in separate bank accounts, and the client needs to be notified of the location. Whenever custody is part of the contract, quarterly statements must be sent to the clients, and the accounts must be verified by an independent audit annually. It's a surprise audit. The firm can't know that the independent CPA is going to come out to audit the amount of money that are in the client's accounts. Investment advisory contracts. They're in writing. They disclose the fees. We've discussed all of the things that are discussed in the brochure. There's a non-assignment clause. We already know that. You cannot trade based upon material inside information. We know hedge clauses are unenforceable in court. Do you think that if a security is federally registered or an investment advisor is federally registered, do you think that that allows them to violate anti-fraud rules at the state level? No. Everybody must abide by, whether or not they're registered at the state level or federal level, or not registered at all. They have to follow anti-fraud rules. The SEC is responsible for enforcing all federal securities laws. The SEC is comprised of 5 commissioners. The commissioners are appointed by the president. The appointments must be confirmed by the Senate. Test question. Confirmed by the Senate, not by the House. Confirmed by the Senate. No more than 3 of the 5 commissioners can come from the same political party. During the time in which they are a commissioner, during their 5-year term, they cannot engage in any outside business activities. So they'd have to have a blind trust for their assets during the time in which they're sitting as a commissioner for the SEC. The Securities Act of 1933 is the federal securities law that requires registration. So the Uniform Securities Act was the state securities law that required registration. Most of the time, if a security is exempt at the state level, it's also exempt federally. But there are a few differences. So we have a chart as far as exempt securities under the Uniform Securities Act and under federal securities law. So these are exempt securities. So if I make an arrow, then the securities are exempt both under state and federal law. U.S. government securities, exempt under both state and federal law. Munis, exempt under state and federal law. Stock or debt of a bank, exempt under state and federal law. Securities issued by nonprofits, exempt under state and federal law. Public utilities and common carriers, exempt under state and federal law. So far, they're all the same. So if you're not sure, just go with what you know. Securities issued by any recognized foreign government, exempt under state and federal law. Pension plans and profit-sharing plans, exempt under state and federal law. So all of these are the same. So 9 times out of 10, they are the same. So when are they different? Commercial paper is always an exempt security under federal law. Commercial paper is always an exempt security under federal law. So these are exempt securities. Always. But if you can remember during the Uniform Securities Act section, when we discussed the whole list of exempt securities, in order for commercial paper to be exempt at the state level, it had to be highly rated, and it had to have a minimum denomination of $50,000. So state law is stricter. It's entirely possible that commercial paper requires registration at the state level, but it's exempt federally because all commercial paper is exempt federally. So by definition, commercial paper is issued by a corporation when they're having a temporary cash flow crisis. It's sold at a discount. It has a maximum maturity of 9 months. So which rule is it that requires the minimum denomination and the highly rated? It's the state rule. State law is stricter. Another difference here is securities issued by insurance companies are exempt securities only under the Uniform Securities Act. So this is one that students confuse themselves on. So let me make sure you don't get confused. Insurance companies themselves are regulated by state law, so that the securities that an insurance company issues, stock of the insurance company or debt of the insurance company, is exempt from registration at the state level. It's non-exempt federally. So those securities, the debt, must be registered federally with the SEC. Totally different question. If you're an investment advisor whose only clients are insurance companies, you're exempt from federal registration. So where do you register? At the state. So IAs whose only clients are insurance companies are required to register at the state level. So be careful. I know so many students have a hard time with that, but you'll be just fine. Federally covered securities are exempt securities under state law. Federally covered securities are registered where? Federally. You know that. And then under the SEC portion, we have what's called SEC Rule 147. This is the rule that allows for an intra-state offering. So this is an offering where the security is going to be sold in one state only. It's going to do registration by qualification at the state level. It's an exempt security federally. An intra-state offering. So when there is no line, so there's no lines up here, there's a difference between state and federal law. So practice those. They're not the emphasis of your law questions on the test, but they're the ones that are the hardest. That's for sure. SEC Rule 147. So most securities are what we call dual registration, where there's a federal registration statement filed and a state registration statement filed. But SEC Rule 147 says that if you're going to sell a security in one state only, you're allowed to have this be an exempt security federally because the security is going to be issued in one state, registered in one state, sold to the people that live in that state only. And it is registration by qualification. This intra-state offering. In order for an issuer to go through with a Rule 147 offering, it must be selling the securities in the same state in which it is incorporated or the same state in which it resides. The company's headquarters must be located there. The company must derive at least 80% of its assets from within the state. It must be doing business within the state. And it must derive at least 80% of its revenue from within the state. All investors who purchase the security must live in that state. And for the next 9 months, there's a legend on it that has the state that it was issued in. The only person you can sell it to is someone else who lives in the same state. After 9 months, it's freely saleable across state lines. At least 80% of the proceeds must be used within the state. So there's lots of 80%, and then the 9-month rule has to do with how long before you can sell it across state lines. So if you bought a security that was registered in the state of Washington, you can't sell it outside of the state of Washington for the first 9 months. SEC Regulation D. This is the Federal Private Placement Rule. The state private placement rule is much stricter. The state private placement rule said that you could make no more than 10 offers. That's very strict. Regulation D is the federal private placement rule. And the federal private placement rule allows you to sell these unregistered, non-exempt securities to an unlimited number of what are called accredited investors. So the state private placement rule has nothing to do with accredited investors. The federal Regulation D private placement rule has to do with accredited investors. You can sell to non-accredited investors as well, but no more than 35 non-accredited investors. So be careful that you do not confuse the term accredited investor with the high net worth individual. The high net worth individual was the person who had net worth in excess of $1.5 million or $750,000 or more in assets under management. That was who we could charge a performance-based fee to. Regulation D is who we can sell shares of a company, shares that aren't registered but normally require registration. So who is an accredited investor? It includes institutional clients, banks, insurance companies, investment companies, but not IAs. IAs are not within the definition of accredited investor. It includes an organization, corporation, or partnership with assets in excess of $5 million. They are accredited investors. And an individual with net worth of greater than $1 million or annual income exceeding $200,000 in each of the previous 2 years and reasonably expected to be so this year, or $300,000 if they are married filing jointly. So be careful. The net worth requirement for an individual to be an accredited investor is lower than that of a high net worth individual. So I remember the high net worth individual has a higher net worth. The accredited investor's net worth greater than $1 million, or they can meet this requirement on an annual income level, $200,000 or $300,000 if they're married filing jointly. So this is the definition of accredited investor and to whom we can sell a private placement under Regulation D. So it's highly likely to have an exempt transaction federally under Regulation D that requires state registration because the state private placement rule is only 10 offers. The Securities Exchange Act of 1934, this is the People Act. So the Act of 33 was in December and the People Act was in January. They were really close together. They just sound further apart than they are. It regulates the secondary market. It defines who is an associated person. It defines a transfer agent. So transfer agent is defined as any person or organization that acts as a registrar by registering transfers of ownership in securities or exchanging and converting securities. So the People Act, it established self-regulatory organizations. The Investment Advisors Act of 1940, most of the regulation for investment advisors comes from the Investment Advisor Act of 1940, and then it's amended over all of these years. When we have a question about who must register at the federal level or at the state level as far as the IA? For example, if you're an IA whose only clients are insurance companies, you are required to register where? At the state level. You were exempt from federal registration. So that was something that was new, something that was an exception. Most of the time, the persons that are excluded from within the definition of investment advisor under state law are the same as those who are excluded from the definition under federal law. For example, banks are never IAs, not under state law or federal law. LATE, lawyers, accountants, teachers, and engineers, they're not IAs if it's solely incidental, not under state or federal law. Broker-dealers if it's solely incidental. Publishers of financial publications of general, regular, and paid circulation are exempt from the definition of IA both under state and federal law. Let's think about this one. Federally covered advisors. Where are they exempt from the definition of investment advisor? Under state law. Only under state law because they're required to be registered where? Federally. You got it. This one's new. Any person who gives investment advice solely related to U.S. government securities. How boring. They're exempt from registration federally. If that's the only advice they give is buy U.S. government securities, that's it. Where would you register? At the state level. Those IAs would be required to register at the state level. So let's practice. Let's say that the IA has a place of business in state A. In state B, the IA has 3 clients. In state C, the IA has another 3 clients. And in state D, the IA holds a seminar on investment advice for 500 people at a country club, doesn't charge a fee for the investment advice, but does advertise in the local newspaper. What states must this IA register in? Well, their home state is state A, so they've got to register there. What about state B, where they had 3 clients? Nope. How about state C? They had 3 clients. Nope. State D, where they advertise? Yes. They would have to register in both state A and in state D. You know that most IAs are going to be registered at the state level. Federally covered advisors include those that manage a mutual fund and those whose assets under management are in excess of the threshold that is in effect at the time that you take your test. We previously discussed this, but it doesn't hurt us to do it again. No matter the size of assets under management, if the IA only advises people that live in their home state and whose advice does not deal with securities listed on national exchanges, where does this IA register? At the state level. What if the advisor's only clients are insurance companies? Registers once again at the state level. We talked about the federal de minimis rule, although it's set to go away at some point. If you have fewer than 15 public clients, you do not advertise yourself as an investment advisor, and you do not advise a mutual fund. You would register at the state level, no matter the size of assets you have under management. If you give advice solely related to U.S. government securities, no matter the size of assets you have under management, you also would be required to register at the state level. So those can be confusing, so I put all of those special rules all in one place. The SEC has special rules as it relates to what's called an agency cross-transaction. A cross-transaction is a transaction where the IA represents both the buyer and the seller of the security. Agency cross-transactions are allowed only if the details of the transactions are fully disclosed to the client, written consent from the client is on file, an annual summary of all cross-transactions is provided to the client, and the client is clearly notified that his consent may be withdrawn at any time. The SEC has specific rules related to custody. They like these. Another review. Securities of each client must be kept segregated and safe. Funds of each client must be kept in bank accounts and must not be commingled. The account must be a joint account with the advisor named as trustee. Separate records of each client bank account must be maintained, and the client must be notified of location and any material changes in the account. The client must receive quarterly statements showing securities, funds, and account transactions. The client and the SEC must be furnished with the advisor's balance sheet on an annual basis. That's part of the requirement whenever custody is part of the contract. And surprise audits of client accounts must be conducted annually by an independent CPA. Solicitors. IAs will sometimes use solicitors, so unaffiliated persons, to solicit business for the firm. There's special rules that relate to solicitors, and there's 50 states, and every state has different rules. But in more than 40 states today, solicitors are required to be registered as IARs. So I'm not saying that that is true in your state, but I am saying that for the purposes of this examination, all solicitors must be registered as IARs. Solicitors have two brochures that they must give out, the firm brochure and a solicitor brochure. The solicitor brochure discusses the relationship that the solicitor has with the IA. So they're basically getting paid a fee for referrals, solicitors. They're really not engaging in providing investment advice. So there's two brochures that must be given out. The brochure must disclose the relationship and the fees that are paid to the solicitor. There must be on-file written acknowledgement from the client that the client received both disclosures. Solicitors are registered as IARs. Advertising rules. The Investment Advisors Act of 1940 says that it is unlawful for an advisor to publish, circulate, or distribute any advertisement that refers to testimonials of any kind. Advertisements cannot refer to past recommendations that would have been profitable unless the advertisement lists all recommendations that have been made in the past 12 months, states specific details concerning such recommendations, and cautions the reader that it should not be assumed that recommendations made in the future will be profitable or be equal to past performance. So you can advertise using past performance if you follow that rule. Thus, most firms don't advertise using past performance. Advertisements cannot represent that any graph, chart, or formula can, in and of itself, be used to determine which securities to buy or sell. There is no magic chart. If there is and you have it, don't tell anybody. Well, definitely don't advertise that you have it. Advertisements cannot contain any statement that an advisory service will be furnished free, unless it will be furnished without any conditions or obligations. So if the firm says, if we do your tax return, we'll give you free investment advice, that's not free. Advertisements cannot contain any untrue statement of material facts or be otherwise false or misleading. The Investment Advisors Act of 1940 prohibits any type of fee arrangement that is contingent upon capital gains or appreciation in the client's account unless. So this is the exemptive relief. This is the time in which the performance-based fees are allowed. Now remember, a percentage of assets under management, if you get paid a percentage of the assets, that's not a performance-based fee. So performance-based fees are based upon appreciation only. They're allowed if your client is a registered investment company, such as a mutual fund. They're allowed if your client has more than $1 million in managed assets and they're an institution. They're allowed if your client is an individual with $750,000 or more in assets under management, or they have a high net worth. So that is a net worth of at least $1.5 million. So net worth of $1.5 million or more. Those are the situations in which performance-based fees are okay. Record keeping. The Investment Advisors Act of 1940 requires investment advisors to maintain accurate and current records. So the records are kept by the IA for 5 years, 2 years readily accessible. So records required of all advisors. Receipts and disbursement journals, general ledger, order memoranda, bank records, bills and statements, financial statements, written communications and agreements includes electronic communications. So all electronic communications must be kept. A list of discretionary accounts, advertising, personal transactions of representatives and principals, client records. Client records will include powers granted by clients, disclosure statements, solicitors' disclosure statements, performance claims, customer information forms and suitability information, and written supervisory procedures. The IA is also required to keep copies of each brochure, brochure supplement, and each amendment to the brochure and supplements that are prepared. There's additional records that are required anytime the IA has custody. The additional records they would be required to keep include journals of securities transactions and movements, separate client ledgers, copies of confirmations, record by security showing each client's interest and location thereof. Additional records that are required to be maintained by advisors that manage client assets includes client purchases and sale history and current client securities positions. How the IA chooses to keep the records is up to the firm. They can keep the records, paper records, tape records, computer disk, or microfilm. In any case, they need to be easily accessible for 5 years, but 2 years readily accessible in their office. If they're kept on any sort of a computer storage format, a duplicate backup must be kept off-site. Electronic records are not required to be backed up by hard copies, but the firm must be ready to provide paper copies to the SEC or the State Securities Administrator at any time. Canadian broker-dealers. Under the Uniform Securities Act, a Canadian broker-dealer who has no office in this state may effect transactions with a person from Canada who is temporarily a resident of the state and who is already a client of the broker-dealer if the broker-dealer files an application for registration with the state, files a consent to service of process, provides evidence that they are in good standing in their home jurisdiction, and is a member of a self-regulatory organization or a stock exchange in Canada. That completes our discussion for legal and regulatory guidelines and ethical practices for investment advisors. There was a total here of 6 separate sections for law. We covered state law, and we covered federal law, and we compared and we contrasted the state and federal law. So the law questions are long and wordy. Please be careful with them. Practice the section quiz. Your ultimate goal is to be able to get to 90% or better on each and every section quiz. These, generally speaking, are the hardest questions on your test, so be extra careful in this area. Good luck. You did it! Congratulations! You reached the end of the video portion of this course. It has been my honor to guide you, but the rest of it, it's up to you. So what do you need to do to pass this test? There's a few things that are important here. It's not going to be so much that you have to print out the PDF and read the PDF all over again. But there are sections within this course that we call key facts. If I told you key facts were like answers to test questions, would you read them? You would. So read them. There's a lot of them, but they just summarize the most important points that are presented throughout the course. So read the key facts. It'll put you to bed every time. But then your mind, it's going to dream about this. And I know that's kind of creepy, but do it. Practice by reading the key facts, and then we have to take all of the practice exams. There's section quizzes and there's final exams within the course. Your ultimate goal is to get to 90% or better on everything. Not because you've taken it so many times that now you know the answer is C. This is an incredibly conceptual test. You have to understand why the right answer is right and what is wrong with the wrong answers. So when you get to the real test and the question is different, because it probably will be different, you'll know how to answer the question correctly. The other thing that you have to promise me that you'll do is on your piece of scratch paper, because you're going to be nervous, at the very top of it, you're going to write, I will pass. I'm not kidding. Just do it. And then send me an email after you go and you take your test and you pass your test. Along the way, as you're studying and working through any of the questions, if you have any questions, please do not hesitate to reach out to me via email. I will always respond to you, generally speaking, within 24 hours. Don't email me 5 minutes before your test. I've had students do that. Then I'll be in yoga and I'll feel really bad if I can't get back to you right away. So, give me a day. Usually I'll get back to you sooner than that. It truly has been my honor to be your teacher. Thank you so much for choosing Test Teachers as your online pre-license education provider. Good luck on your test.